You likely hold a lot of SCHD in your portfolio, or you're at least considering it, so this video is going to be very important for you. About 1/3 of my portfolio is SCHD, so I'm right there with you. There's no doubt that this has been a slow stretch for SCHD over the past 2 years or so. This year it's actually down worse year to date than a bunch of other indexes. SCHD right now is down about -2.51%, where year to date S&P 500 is up 2.38%, and the NASDAQ 100 is up 4.05%. In this video, I'm going to give you some quick highlights as to why it's down so far, and why it's still down while a bunch of other indexes have risen and have actually corrected. I'm also going to give you the actual data and facts and numbers, because most of the time you're only seeing half the picture, especially with a fund like SCHD, so this is going to help in your decision making. Then I'll give you some alternatives to think about, because I want you to build the portfolio that's going to be best for you, and maybe for some of you SCHD isn't it. So long term, let's just build out the best portfolio that's going to be best for you. My name is Nolan Gouveia, my students call me Professor G, and I made this channel to make investing simplified. So here's 3 key reasons as to why SCHD is down. Number 1, that annual reconstitution was just mistimed. The SCHD rebalance occurred on March 21st, 2025 during a turbulent period of tariff uncertainty and market volatility. The fund had to sell out of some defensive names and add others that didn't hold up right away. In Q1 alone, SCHD fell 1.16% versus the S&P 500's 0.36%, primarily due to weak performance in utilities and consumer staples, which make up a large part of its defensive tilt. The second reason why it's down right now all has to do around that energy. The March rebalancing nearly doubled the energy sector exposure from about 12% to about 21%, introducing greater volatility since energy stocks are cyclical and commodity sensitive. While energy has outperformed earlier this year, sharp fluctuations like oil price dips have weighed on SCHD's defensive profile. Third reason why it's down is probably the biggest and most important for you to understand, and this is the T-bill or bond yield comparison. Rising yields on short-term treasury bills and money market instruments have shifted investor preference away from dividend-focused ETFs like SCHD, as these alternatives now offer comparable or higher risk-free yield. So think about it. If safety is your goal, if that's the number one thing that you care about at this point, bonds or T-bills or even high-yield savings accounts or money market accounts provide even more stability, which are less risky because they don't have anything to do with the stock market. Equities or stocks just fluctuate so much, and so just inherently, if you're invested within that type of instrument, you're going to see more risk. So right now, if you can get something like 4 to 5% guaranteed through bonds or through T-bills, or even at the high yield savings account or money market account like I was saying, and you can get basically that through risk-free because it's not going to fluctuate like the stock market, why would you choose SCHD over something like that? A lot of my clients are incredibly wealthy. When you get to a certain point in your portfolio, you care way less about just getting a little bit more growth and way more about wealth preservation. Same thing for these huge institutions and hedge funds. What they're trying to do is make sure and keep their clients safe, but also provide somewhat of cash flow if that's their goal. So if the goal at the end of the day is to get 4 to 5% or so in cash flow, they're going to choose the safest route to do that. And right now that would be like a high yield savings account or money market or whatever it is, because the rates are so high. Now down the road, when the Fed starts to bring down the rate and rates just overall drop, now you're going to see things like a 2%, maybe a 1% in your high yield savings account, maybe a 1% in your money market account. Now it's a little bit less attractive for these people to hold money there, because if you're only earning 1% interest or something, and statistically and on average we're seeing inflation of 2 to 3%, it just doesn't make very much sense to hold it there. Then at that point you do need to increase your risk just a little bit, and the next least risky place to put it would be something like SCHD, and you're getting that cash flow of around 4%. So SCHD being down makes a lot of sense in a lot of different places. The main thing that we need to understand though is this something to continue to invest in or even hold? Long term, would this be the smart move? SCHD is a fund that's built up of defensive stocks or very boring stocks in nature, which makes it much more stable. It's a value fund with a lower beta than the S&P 500, so it's a defensive play in people's portfolios to keep a well-rounded and disciplined approach. It gives out a nice dividend of 3.5 to 4% on average, and it's a qualified dividend, so it's taxed at long-term capital gains rate, which is much more favorable than income rate. If you're looking to own this fund, you're getting not only one that is appreciated solid for a value fund, but also one who has a very solid dividend growth rate. Plain and simple, you should not be looking for this to be a crazy growth ETF, but you should expect some great long-term results if you're looking to buy and hold. Here are the actual numbers that you need to understand and you need to see. Remember that return and total return are two totally different things. If a fund appreciates, like their price appreciates, goes up by 5%, that's half of the equation. You also need to understand how much was the dividend, or was there a dividend? If a fund goes up 5%, but then it also has a dividend, so you gain a yield of 4%, you take that 5% that it went up, and you take the 4% that you received or that was paid out, and now you got a 9% total return. Because most of us are taking that 4%, we're not just using it as cash flow, we're usually reinvesting it back into the fund. So you really made a total return of 9% if those were the numbers for that specific fund. When you look at the chart of SCHD, if you just type it in right now and see how it's doing year to date, or even the year to date total that I showed you at the beginning of this video, that's just showing you return or price appreciation. That's not total return. So here's the total return of SCHD each and every year for the life of the fund. So this is found at totalreturns.com, and this is great because this is gonna show you everything that I'm gonna show you on this here comes from 2011 to literally June 2025. So first and foremost, as of right now, that year-to-date return is a negative 1.39%, which is lower than what I showed you, or better than what I showed you at the beginning of this video, because the beginning of this video had just its return, not the total return. Remember that this is SCHD total return chart with dividends reinvested. So the first thing that we can see here is from that 2011 to right now, mid-2025, this is the chart and what it looks like. If we look at the overall return altogether, it's been 388%, and what that actually comes down to is about a 12.4% per year. Remember, this is from 2011 to literally this last month. That's a pretty solid total amount to be gaining every single year on average. Let's look at specifically the annual returns. As you can see here, a lot of green. There's only 4 times that this fund returned negative for the entire year. And one that I want to highlight is this one right here, because this is 2022. In 2022, the S&P 500 went down negative 18%. This one only dropped 3% that year. Right now, it's down 1.39%, which is not fun, but looking at how large each and every other year has gone up and how infrequently this fund is down overall, and then even the total amount that it's down overall, just makes me think that SCHD is just such a solid play. At its worst, over this entire time, the worst that it was down is negative 5.5%. I can definitely live with something like that, knowing that the next couple of years was 27, 15, 29%. And right now I just want to call attention to that negative 1.39% year to date as of right now. There's so many people writing comments whenever I talk about SCHD saying SCHD is a dog, it's a terrible fund, this thing doesn't ever move. I mean, literally last year it went up over 11%. And right now, in a very bad year for SCHD, where it's doing worse than some of these other funds, it's only down about 1%, and everybody's getting crazy about that. I think we need to have a bit more patience and understand and see the long-term effects. That's why I wanted to show you all those numbers. I even like that it was green and red, so you could just very much visualize this has been a great fund and very positive for quite some time. I also wanted to show you that there were bad years in there, years where the S&P 500 or other indexes that people are totally fine with did worse than SCHD, way worse than SCHD. Now, past performance doesn't mean future results, but it is good to take the data and just be able to understand that it wasn't just a good period that SCHD did good, it did less bad in bad periods. And I also think that down the road, if there's ever a year that technology does very bad, if AI just hit that certain threshold and it just has to drop for a little bit because that's the way market cycles go, at that point, everybody's going to be hating on the growth ETFs or even the S&P 500, and everyone's going to love SCHD at that point because it has such minimal technology exposure. So keep that in mind. And I don't want to have to bring out the receipts at that time, but I'm also not above it. All right, so what do we do now? How should we invest? First and foremost, this is your portfolio. You need to figure out what's the most important to you. Do you care about certain cash flow? Do you care about price appreciation overall? Are we talking about a retirement fund versus a brokerage? Do you care about taxes? There's a lot there that you need to figure out. What's your risk profile? How fast do you need this? Is this long-term or is this short-term? And if it is short-term, if you're looking for something very, very short-term, then I can understand the uproar around saying that SCHD is a terrible fund when it's down 1% in the year. But if you need the money right about now, or if you want something to grow very quickly in the next year, this one maybe isn't the best thing for you. Long term, this fund has proven itself, and there's a reason why it's a core position in my portfolio. If though you care about bigger dividends, if SCHD just isn't appealing to you because the dividend's a little bit too small, then maybe you're going to want to look at some covered call ETFs. The ones that I like best are SPY-I or JEPI, or QQQI or JEPQ. Those are the ones that are most proven in my opinion. There's a bunch out there that do have higher dividends than those, but I'm definitely skeptical on those. Most of them are a yield trap and you just need to be very careful. If you care more about just absolute safety and you're just looking for the safest thing possible, least amount of risk possible, but still gives you a little bit of cash flow on your money, then why not just do a high yield savings account or money market account or bond, short-term treasury bills, SGov, something like that, where you're gonna get 4 to 5% pretty much risk-free. Again, that's a short-term thing because as those rates drop, so will that yield. If you want to focus more on price appreciation and growth right now, then you definitely want some exposure to those higher growing ETFs. At the very least, you want a market average or market weighted ETF, something like the S&P 500 with VU. But more growth would be things like QQQM, VUG, SCHG, even VGT or SMH if you're looking sector specific for technology and semiconductors. Just know that I hope that you proceed with caution with those. Those are hot right now, those are great right now, and I do believe that we should all have a piece of that in our portfolio. I'm just worried when I see people say, I'm just gonna go 100% growth, and then once it makes a bunch of money, I'll switch it over to dividends. You're just not guaranteed that that's going to 100% work and that you are gonna grow. Those are the ones that fluctuate the most. They go up 30%, but they can drop 40%. Just be careful. My personal opinion, the way that I've built my portfolio, and hundreds of my clients are definitely jumping in on this as well, and it's been working very, very solid, would be to build out that 3-fund portfolio and customize it for your risk and your time and just exactly what it is that you need out of your portfolio. To see how to do that best, watch this video here. It's gonna go over it in detail and help you out there, but it's very, very simple. Or you could watch this video to keep you going strong in your investing journey and keep investing simplified.